All right, everyone. Good to see you. Thanks for joining in. Looking forward to doing this presentation. I'm just gonna get the camera kind of angled there, like that, with the bright lights aren't in the way. Awesome. Well, thanks for coming out. Today was a good day. The Bank of Canada did not increase interest rates. So many of you that are in variable rates, finally some reprieve. And no, the rates aren't going down, but at least they're not going up, which is great. So it's good to see a little bit of good news. We haven't had enough of that in the last little while. So let's get into it. Let's talk about interest rates and what's happening with the Bank of Canada. It's been a roller coaster ride since COVID started. March of 2020 is really when things started to go really, really bonkers and weird. And one of the questions that we're having now is now the time to buy? I'm going to talk a little bit about what's happening with interest rates, a little bit about what's happening in the real estate market, some of the trends that we're starting to see, and talk about that. And the short answer to is now the time to buy is it kind of depends. So let's talk first about interest rates and get into that. Everybody always wants to talk about interest rates, and it's been quite a topic over the last couple of years. So first of all, what happened? We're in an interesting position. The Bank of Canada had to figure out one of two things: either raise the rates slowly, risk inflation, but reduce the likelihood of a recession, or raise the rates quite quickly. This would combat the inflation, but then they would risk a recession in 2023 or 2024. Very clear which one is on the table and which one is off the table. Interest rates rose very, very quickly, and obviously the bank took very swift action to try to curb the inflationary environment. This is the Bank of Canada's policy interest rate. So this is what's called the overnight lending rate. This is how the prime rate is determined, actually. It's based off of the overnight lending rate plus 2.2%. So the prime rate right now is 7.2% based on this. And yes, the Bank of Canada finally did just a hold, which is good news for us all today. Now, as far as how much the Bank of Canada has gone up, they've got up 4.75% over the last 18 months, which is very aggressive. As a actual interest rate, it's not more than what we saw in the early 80s, but as a percentage of where interest rates were, the interest rates basically have gone from prime rate being 2.45 to being at about 7.2%. That basically quadrupling of the interest rate is more than we've seen even going back to the early 80s. Of course, in the early 80s, we went from high single digits to numbers that were in the high teens for interest rates. But that was a doubling of interest rates, not a quadrupling of interest rates. So it's interesting when you work off of such a small and low interest rate environment, how much interest rates going up as much as they have can really affect every one of us, right? Let's talk a little bit about what's been happening. So this chart that I have is talking about bonds, and the reason I have bond yields up on the screen here is that the bonds impact fixed rates. The Bank of Canada, when they move the prime rate up or down, that affects anybody that's in or going to take a variable rate mortgage. So if you take a variable mortgage, it's the prime rate minus some kind of discount, and then your rate fluctuates and moves up and down based off of that. When you're taking a fixed rate mortgage, you're buying into a contract and you get that rate for 1, 2, 3, 4, 5, 7, 10 years. And what ends up happening is lenders lend out to you and me, then they turn around and bundle up mortgages and then they sell them out the back door. And when they bundle them up, it's called securitization. The mortgages are called mortgage-backed securities. And so basically, an international investor can either buy a bundle of mortgages or they can buy bonds. So they're very, very similar asset classes. And so that's why you'll see that when the bond market is moving up and down, generally speaking, fixed rate mortgages are moving up and down. Now you can see on this chart, during COVID, the interest rates were very, very low, and that's due to something called quantitative easing. It's a process in which governments are pushing a lot of money into the bond market, and that keeps the yields quite low. So basically, if there's money flowing into bonds, it actually pushes the yields down. If there's money flowing out of bonds, then the value or the yields go up. And so there was a huge $50 billion bond sell-off at some point earlier in 2021. And that caused the fixed rates to go up a little bit, and so that's where you see that bump up. Then you saw interest rates continue to climb, and then you saw the Omicron situation. So all of a sudden, oh, new variant, maybe this will be bad. And we saw the interest rates started to drop. And then again, they started to go up, and then an immediate drop when the Ukraine situation started to happen. And then they started to increase again, primarily due to something called quantitative tightening. And so that would be, instead of the government's putting money into bonds and pushing down the interest rates, instead, they're selling off their bonds and getting rid of them. Money's leaving the bond market, and therefore the yields started to increase. And so heading into the late 2021 and early 2022, we can see that obviously there's a lot of changes, and really by the end of 2022, the bond market had gone up over 2%, probably about 2.5% is the increase. So it was quite substantial. Heading into 2023, the Silicon Valley Bank thing happened right in the very beginning of the year. Again, that was a interesting situation. It was effectively a bank crisis, and it actually caused the bond market to drop more than it has in a really, really long time. I think it was, again, about 30 years or 40 years. We haven't seen the bond market move down that much over about a 2-day period. So there's a lot of concern about this being a spin-off effect, and that interest rates may actually follow. And so in the beginning stages of 2023, we actually saw big swings in the bond market. So first, in early in January, Bank of Canada paused the hikes. Interest rates started to drop, which was great news. And all of a sudden, oh, never mind, the U.S. inflation and CPI numbers, they're really, really bad. We actually are seeing the interest rates swing back up again. And by the way, these are very, very big swings when you're talking about the bond market. Looking at where the Bank of Canada was, or before the Bank of Canada mentioned they were pausing, that was a bond of about 3.4, then it dropped down to about 2.8. So basically a 0.6% difference over a couple of weeks. And when you see a 0.6% difference, in many cases, the mortgage rates would have dropped by almost 0.6% over that time period. And then all of a sudden, a huge swing back up. Oh, the U.S. inflation and CPI numbers are really high. Bonds went from 2.8 all the way up to 3.6% or 3.7%. And then all of a sudden, we had those bank failures. And those had a massive impact. You can see that it was the interest rates fell off a cliff and fell really, really low, from 3.6 or 3.7 down to about 2.8. So about a 1% decrease almost. Then we had some squiggles and wiggles. And then again, U.S. inflation, the CPI numbers, and of course, Canadian numbers coming out around these times too. And it's skyrocketing the bond market. So huge swings in the bond market. And so to really take a step back and look at, what really happened over the year since then, there's been some movement and some up and down. But overall, the bond market got up to about a 4% interest rate or yield. And it's been hovering around that number for quite some time now. So really, since about June or July, we've been around the same number, and that's where we've seen fixed rates hang around the same number as well. And so we've slowly seen the steadily small incremental increases to interest rates over the last 2 months here, and obviously the major increases that we saw were back in late May. We have a lot of clients that have rate holds that we secured for them back in the end of May that expire the end of September, and their new rate is about 1% higher than the rate that they had held that lasted until the end of this month. And so there's a bit of an incentive to try to buy something this month and close this month if they can, if that's possible. In general, if you wanted to understand where a fixed rate mortgage would be, you can usually add anywhere from about 1.5 to 2% on top of the bond yield. And that would be the approximate interest rate on the mortgage. One other interesting factor here too is that in some cases, we've seen that the spread over top of bonds can be compressed and can be smaller. But right now, there's some concern where the banks are having to put a bit of extra money aside to compensate for what might be future losses on their books. And so they're starting to take a bit more of a thicker spread on their on that spread over top of bonds, just to make sure that they have a bit of padding. So we're finding that right now, even if the bond market didn't change at all, but if the market relaxed a little bit and there was less of an expectation of a future recession, then we'd probably actually see that the fixed rates would come down just slightly because that spread over top of bonds would start to come down and compress a little bit. Now, why did interest rates skyrocket? Inflation. And at least the good news here is that the inflation numbers have been decreasing. So if we go from last year where the inflation numbers were over 7%, at least we've been seeing some progress here with the inflationary numbers starting to continually decrease. And it seems like we're probably settling in somewhere around the low threes, and it'll probably stay there for a little bit of time. There's some discussion and talk about where the Bank of Canada wants to be, and their target typically is a 2% inflationary number. This is very, very hard for them to reach that figure. And the problem is that even just oil prices bouncing up and down are going to jumble that number up and down. One of the big keys as well that resulted in the Bank of Canada not moving the interest rate on this announcement was that late last week, some data came out that that the Canadian GDP, so gross domestic product, basically Canadians' production, had decreased and pulled back in a fairly large way. And so it's an indication that a recession is likely to come. And so the Bank of Canada is stuck in this tough spot where they continue to increase rates. They're just hammering the economy, as putting it into a higher likelihood of a recession. If they lower interest rates, then they're likely to push inflation up. So they're kind of teetering on the edge here, and it's a really tough call for them. But the ultimate situation here is they're really trying to aim for a soft landing, and so they're trying to keep the interest rates high for long enough that the inflation can die down. And then as soon as the inflation dies down, they're going to try to inch down the interest rates to make sure that a recession doesn't quite happen. But it seems like anecdotally, we're hearing a lot more about people not, people getting laid off, people not being able to as easily find work. But that number, the unemployment number, is still very, very low. I was watching or listening to somebody speak just the other day about this. I think it was CIBC's economist Benjamin Tal, and they mentioned that a point at which the economy doesn't have inflationary pressures is usually around unemployment of 5.9%. And we've been in the low 5% recently. So we recently saw an increase from, I think it was 5.1 or 5.2 to 5.2 to 5.3 or 5.4. So we're still in the low fives. But as we inch closer to the 5.9% number, it should result in less inflationary pressures, especially from the employment factor. And so I think that as we start to see unemployment continually increase, if over the next couple of months that number continues to slowly climb up, then you'll see that the government will be more incentivized to either decrease rates or at least not continue to increase them. So the question is, will rates go up or go down? There's a lot of moving parts to this and a lot of factors. As of now, the Bank of Canada's position is that they're currently paused. But remember, they were also paused back in January. And January was a long time ago. Interest rates have moved up quite considerably since even January of this year. So there's a chance that they may go down this year, but it seems unlikely. The more likely outcome is that that you'll see for the fixed rates, for instance, probably going to be about flat. That could go up or could go down this year. It's really hard to tell with the bond market, but we're expecting likely flat. There are some factors that could result in the bond market continue to go up, which means fixed rates could continue to go up. But flat and of course they could also go down. So it's a really tough tell, I would say, on the fixed rate market. I think on the prime rate side of things is that it's seemingly a little bit more clear with the data we have today that the prime rate is likely to stay flat for the rest of the year, or maybe increase one more time, maybe. So I'll show a chart in a second that talks a little bit about that. But of course, one of the challenges with looking at this and trying to make predictions is that almost everybody that makes predictions has been wrong for the last 18 months. If we look back at the expectations in spring of 2022, so after the inflation numbers were quite high, and looking at what all of the major banks were predicting as far as where their interest rates would head, every single one of the banks assumed that the prime rate would get to about 4.5 to 4.7%, somewhere in that range. And we of course have shot right through that, right up to 7.2%. So we're about 2.5% higher than all of the major banks expected for us to be as of just over a year ago. So people were very wrong about this, and it's very hard to make predictions. But I know all of you are still looking for some kind of prediction on what's happening with interest rates. And so this is what's called implied rates. And effectively what it is it's people that bet on where the interest rate will be in the future. And so if right now the Bank of Canada rate is 5%, then basically what they're showing here is what their expectation is. And it's getting right down to, you know, the 0.01 of exactly where they're expecting rates to be. And so the way to look at this chart is that, as an example, if in December, the implied rate is about 5.1, that means that right now the rate is 5%. Bank of Canada always moves in quarter point increments. And so it looks like they're probably pricing in as high as up to a 40% chance that maybe the Bank of Canada goes up 0.25% in January. So that seems to be the peak. And this is what we experienced earlier, by the way, is that leading up to the Bank of Canada announcement today, if you asked us 2 weeks ago, it seemed like there was closer to about a 50% chance the Bank of Canada moves up. And then a few pieces of data come out. The GDP number in particular comes out. Oh, never mind. It looks like we're going to pull back on that. But the next set of data could show heavy inflation numbers. Also, just pausing could also cause enough inflation because it gives people some comfort knowing that, oh, great, Bank of Canada paused. Now I can go spend more money because they don't have to worry about my cost of borrowing. And that could spur the economy again, and then inflation kicks back up, and then at a future meeting in October or December, Bank of Canada has to step in and increase the rates, which is exactly kind of what happened back in January of this year when they paused, and then a few months later it started increasing again. So looking at this, another really important observation I want you to look at is as we start to get into later next year, July, September, October, that interest rate starts to decrease. And so what they're implying there is that they're expecting that by the second half of next year, that there's going to be some pressure on the Bank of Canada to start to decrease the rate. Now, predicting this far into the future with all of this competing data and information is very, very difficult. But these people are literally betting on it, so they have a financial incentive to try to get this right. And this is where people are trying to get this information. James, you're asking, like, where do you find this implied rate data? It's I pay for a subscription through a site that sends out newsletters and information on that, so I'm able to grab this from there. There are a couple of data websites that do offer this. Often what you want to look up to get this is overnight index swaps. So the OIS market is what usually will give you this information and data. It's not easy to get unless you're willing to pay for it from somebody else. Unfortunately, I've tried to search this for myself, but it's quite difficult to get unless you're paying somebody for some kind of subscription or something. So, given that information, we've been in a situation where most of our clients have been taking short-term fixed rates. So the most commonly chosen term chosen with us has been the 3-year fixed, followed by the 2-year fixed, but there's a pretty big drop off. Like the 3-year has been the most popular by quite some margin. And then the 2-year fixed, followed by the variable in certain cases, just if somebody was looking at maybe flipping the property, holding it for a short period of time or something like that. And then the 5-year fixed would fall somewhere around the same spot as the variable too. And the reason that people have been taking the 5-year fixed has primarily been because we're in a weird time where the shorter the term, the higher the interest rate. And this is because the market is expecting interest rates to drop. So a 1-year fixed is over 7%. A 2-year fixed is around 7%. A 3-year fixed is in the mid 6s. A 4-year is probably 6.25. 5-year probably closer to 6%. So we're finding that this is the trend. Now, especially with insured mortgages, there are some lenders out there that are still offering like 5.39% for a 5-year fixed for an insured mortgage. So that's when you're putting less than 20% down and buying either a second home or a personal residence for yourself. And in those cases, at a rate that's a full 1% lower than the 3-year fixed, it could make sense to be taking a 5-year fixed instead of the 3-year fixed, just because the spread and the difference between the rates is so great. Even if you look at where rates would have to be in 3 years' time, we've done the analysis, and the analysis has showed us so far that the rates would have to be in the low 4s, like 4.1 or 4.2%, for you to be better off taking the 3-year fixed and paying, just over 6% for 3 years, and you'd have to renew at a rate of 4.1 or 4.2 for years 4 and 5 to equal the same interest cost as if you took a 5-year fixed at 5.39 or 5.49%. Again, those rates are insured mortgage rates for that low 5-year fixed rate, where there seems to be a lot of competition right now. And less so for a real estate investor, somebody buying a property with more than 20% down, buying a home over $1 million, et cetera. Now, the other interesting part is that all of a sudden, and most lenders are by the way, offering pretty small discounts off of prime, but there are some lenders are offering deeper discounts off of prime on their variable mortgages. And so you could be looking at prime minus 90, even prime minus 1 with certain lenders. And that rate is actually about the same or even slightly lower than the 3-year fixed rate, which for about a few months, the variable rate had always been higher than the 3-year fixed rate. And it also felt like we weren't really sure what the end would be as far as the interest rates were increasing. Not to say that we're sure of this now, by the way. We really are not sure about how high rates could go and will go. It does feel like we're really starting to feel the pain, and the data is showing that. And so it feels like we're getting closer to that end. It doesn't seem like they can go a lot higher without feeling the consequences. But all of a sudden, it's starting to make sense to possibly take a variable if you're the gambling type. If you're somebody that feels comfortable with the risk, you're somebody that can afford it if the rates jump up another 1%, knowing that they have the ability to jump down 1% or 2% over the next few years. So one of the things that we have in our office is we actually have a spreadsheet that helps us compare short terms and long terms. And I wanted to pull this up and just give everybody an example. So if I compared a typical mortgage of $600,000 funding in October on a fixed rate, 3 years, on a 25-year amortization, 6.49%, and I compared that versus a 3-year variable term, 25-year amortization with a discount of prime minus 0.9, you're actually looking at a situation here where the payments are 16 grand lower over the 3-year period. You pay down 6 grand in principal, and the interest cost is $22,000 less on the variable than it is on choosing a fixed rate, which is very interesting. That's because you're starting at about the same starting point, but then the rate would decrease. And what we've used for this pro forma or for the calculations here is that the Bank of Canada stays flat until next July, then they decrease by a point, and then they decrease every quarter by 0.25% for the next couple of years. And so effectively by the end of year 3, rates would be about 2% lower than they are today. So that's the expectation that we currently have built into the model to run these numbers, and it makes a pretty substantial difference. So, I mean, to paint a picture, if the rate was down by about 1% for the first year, or after the first year, then you'd be saving about 1% on $600,000 is 6 grand. And then in the first year, if you save just a little bit of money because the rate was about the same for about 9 or 10 months out of the year, then you're going to save a couple grand. But then it's year 2 where the rate would be 1% lower on average throughout the course of the year. That would save you about 6 grand. And the second or the third year, I should say, would save you over 12 grand by being in a rate that's about 2% lower. So it's interesting that the math was this great. I was actually a bit surprised. But of course, this is only if the Bank of Canada does what we think they might do. And by the way, if we run this analysis 6 or 12 months ago, the variable seemed to pencil out better, but we were still quite nervous about having clients go into variable at 6 or 12 months ago. Looking at this now, it seems like maybe now is the time to get into variable, but you have to be prepared for what might come, and what might come may be more interest rate hikes. So just consider a variable. And only a few lenders are actually offering a discount off of prime of that deep, by the way. On the market itself, I'm not going to go into a lot of the macroeconomic data. You can get that from your realtor and have conversations with people that follow this at a more normal level. So my objective here is to look at this from a more boots on the ground level, and also from a investor standpoint, because we have a lot of conversations with real estate investors about where they're buying and what their feelings are. So as of now, it's interesting because it does seem like the real estate market is still quite active. Normally, every year, the 2 quietest parts of the year for us usually are the second half of December, of course, you know, the holiday season, and then usually the second half of August, because usually people are on vacation. For whatever reason, the market actually kind of picked up a little bit heading into the second half of August, and that could just be a blip. I do think that the Bank of Canada is staying flat, will at least not take wind out of those sales, and I think that it will continue. But I will say this, I'm not expecting the real estate values to increase. I think they have a slightly higher chance of decreasing into the last bit of this year than they do of increasing. And so if you're trying to sell a property and you're waiting for the market to go up, I'm not sure if that's the right play. I think that if you're selling, you know, you have a higher risk of the values decreasing than you have of them, of the upside of them increasing, in my opinion. And so that's something to think about. As an investor, what I'm observing now is that some of our clients that are in financial difficulty, they're finally getting to that point now where they're starting to come to realization that they might have to sell their property. And most people were trying to hang on, but the number of fingers was slowly falling off before now they only have one finger hanging on, and it's getting a little bit tougher. I think one observation is that a lot of consumers, when COVID happened, there's so much money getting printed that people had a larger amount of savings sitting in their bank account than they've ever had. And that's one of the reasons that it actually caused inflation. You had more money chasing less goods. However, that excess cash has been depleted in many ways because now people's servicing costs, their rent or ownership costs have gone up. And so it's become more expensive. And it's been, it's been an 18-month cycle so far of interest rates slowly and well, not slowly, but increasing. And that amount of money in people's bank accounts has been decreasing. And so that effect is starting to cause some people, I believe, to now be in a position where they might have to be forcing their sales and forcing their homes to go up for sale just to make ends meet. So Alex, I don't think that this year's tax assessments will have dropped from previous. However, I think they're about the same because it is based on July 1st. And one thing to keep in mind is that when the Silicon Valley Bank thing happened and interest rates dropped temporarily, the market was roaring again. Like we felt in the industry, we were like, oh, we're back to being crazy busy again. It was multiple offers all over again. The values were increasing. We had one of the largest month-over-month increases, I think, in April of that year, or this year, April or May, where I think the values increased like 6% month-over-month, which is a really high increase for like one monthly jump. And so if the tax assessments are due on July 1st and they're based on that date, then keep in mind that values may have decreased a little bit, but they would have ramped up right before July 1st. So I don't think it would have much of a change. And the government doesn't like to swing the values back and forth a whole lot. When the market goes up a lot, they don't tend to go up all the way. Also, when they come down, they don't tend to go down all the way. They try to keep it at a more even keel. So that's my expectation. But it'll be interesting to see what happens. I do think there'll be some people that have to sell, and I think you're going to see some more of that coming through. As an investor, good to keep your eyes open. There'll be some opportunities that come up. And I think that that's something that you want to take a look at and just observe. So the question that I get asked a lot is now a good time to buy? And my answer is not really. My concern, however, is that we fast forward a year, but probably more like 2 years. And is that a good time to buy or a better time to buy? And I'm not so sure that that's a better time to buy than it is today. Like if you want to get into the real estate market, my concern is we have a couple of factors that are going to all squeeze together and are going to make this really complicated for you. The first thing is we have a ton of immigration. A lot of people move here, they rent to just settle in, figure out where they like to live, and then they go ahead and start to buy. We're starting to see a lot of those applications. We have a lot more first-time home buyers, new to Canada borrowers now that are looking to buy, but it takes them some time. They want to be here for a year or two before they start to get active and start to look at buying their own home. So that's one factor where we have an increase in demand for housing. The second factor that we're seeing right now is that a lot of small to medium-sized developers are choosing not to start new projects. And that's happened since about 12 months ago when this all hell was breaking loose. For them just to go ahead and try to pre-sell their units. It's harder for them to get financing from banks right now. They're very, very tight. They have to pre-sell a number of their units, and that means they have to sell in what's a weaker market. But they still have inflationary pressures on their costs. and there's still concerns about that. And so their margins are getting really thin. And so for a lot of them, they're just making a decision to say, hey, you know what? Be really picky and choosy with what I do. And if I don't do a project, I'd rather not do a project that could lose me money than just do something just for the sake of doing something. So you see those bigger companies, they'll be more likely to just keep rotating through because it doesn't affect them as much. But you're going to start to see a little bit of an effect, I think, in the next 12 to 24 months, where less new product is hitting the market that otherwise would have. And that's going to cause a supply and demand imbalance. We're going to have a lot of demand from incomers and a lower supply hitting the market than we should have. And on top of all of this, we are all expecting interest rates to start to drop, probably starting in the second half of 2024. But I think it'll be a bit more likely that it'll hit more in 2025. And so looking at that, interest rates dropping, that will cause demand to go up. Immigration is already causing demand to go up. And then you're going to have a lower supply. And what is that? It's a recipe for multiple offers, people jumping over each other to try and buy something. And so the question is, is now a good time to buy? Not really, but I worry that if you try to buy something in a year or two, it might not be a great time. So the best opportunity might be the next 6 months. I think that you're going to see people that are in some pain. Those people are going to be motivated sellers. If you look at the market lately, there's been a very low supply. In fact, it's been, I think, in many cases, as low or even lower than it was like right during COVID. And so low supply, that's a concern. And depending on what exactly happens with this market, I think you might look back and say, you know what, 2023 didn't seem like a great time to buy, but it seems better now in hindsight than if I just, buying in 2025. Especially if you just take a short-term fixed rate or variable rate, it's going to suck for the first little bit. It probably won't cash flow if you're putting 20% down, to be perfectly honest. But at least you're getting your foot in the door. You have a tenant pay down your mortgage for you, and you've locked in the price. And then over time, with inflationary pressures on rents, pushing the rents up, interest rates coming down, you'll find that eventually your cash flow will even out, and it'll be easier to get something that's cash flowing than in the future. And so, yeah, Joanna's saying so it's a seller's market, and it should be more so in the future. Yes, I'm feeling that it'll be more so in the future. Even just looking at the demand that we had roaring into the market this spring when the Silicon Valley Bank thing happened and rates dropped, it was insane. It was multiple offers left, right, and center. And so unless the supply increases in a very substantial manner, we're going to see that it'll be another seller's market in the next 12 to 24 months period of time. It could be another boom. So very important announcement. I have something that I wanted to let everybody know. This is something that if you're on you probably do get our emails. We would have sent an email about a week ago. We've finally launched our underwriting product called Atlas, and we're very excited to be launching that. We are now testing it for Green Mortgage customers and starting to use it. So this is the beta version, very early stages that we're testing it out. However, here's the premise of it. It actually allows us to look at your qualifications and your options with no documents, no credit inquiry. It evaluates your options with 32 lenders, and then it delivers you a report within 5 minutes of you filling in the online form. So it'll tell you how many lenders you qualify with. Very soon, we'll be adding in the feature to also show you what rates are available with all those different lenders. So more importantly, at this point, it's more about do you qualify or do you not qualify? But the really nice feature is that with this information inputted, it also allows us to then tweak your information to say, well, if you sold this property, you can qualify for this much. If you kept everything, you can qualify for this much. And so without you having to send in a bunch of documents, it's much faster and easier for us to assess your situation. And so, so we've launched this. We're very excited to have that. This is what it looks like on the back end for us. So we're seeing a bunch of this information and on our end that shows us all of the different lenders and the rates available and all these details. It highlights whether the deal works or not. I know this looks like a mess to you, so don't worry. That's not what you see. This is what you see. You see one nice clean one pager. It talks about how much you qualify with different lenders. It'll even rate your properties in order of which ones affect your debt servicing the most and the least. So if you have a portfolio of 6 properties, it'll tell you hey, by the way, these properties are affecting you the least, and these ones are affecting you the most. And so it gives you a bit of data on that. If you do want to get more information about this, then just email us, and we're happy to send you the link for the Atlas form. Also, we did send an email to everybody last Tuesday that talked all about Atlas. So check that out. And again, it delivers the report very quickly. And then we set up a call with you to go over it and just answer any questions you have. If you have any clarification items, or if you did want to pursue action with that information, then we can, of course, give you the next step based on that. So feel free to book a consult with us and chat. I know a lot of you are in a tough spot, and it's very, very difficult to know what to do next and what step to take. A couple of things that are really important right now. It's more important than ever to compare your rates when your mortgage is coming up for renewal. In many cases, it does make sense to just renew with your bank. In some cases, it just will look at it and say, you know what, the rates are pretty good, just renew with your bank. But at least you got a second opinion on that. But we have had some cases where we say, you know what, we can save you 0.5% on your $1 million mortgage. So that's going to save you $5,000 a year in interest. It's substantial. So you got to keep in mind that some cases there are situations where you can save a lot of money by moving and switching your lender and moving it to a different lender. So make sure you're comparing your rates on renewal. That term chooser spreadsheet that we have, it allows you to compare a fixed mortgage versus the variable rate mortgage, which is actually, I took a bit of a snapshot of some of the data that you get in that spreadsheet and showed you in this presentation. Also, it allows you to compare a short-term fixed rate versus a long-term fixed rate to look at the break-even rate after the expiration of the shorter term. So it will give you an idea to help you make a decision on which term you should choose. And then, of course, if you're interested, learn more about Atlas and let us know. Last but not least, I did write my book, Rockstar Real Estate Investing. I recognize that a lot of you on this webinar, so many of you already have it, but if you do not, then please send an email to info@greenmortgageteam.ca. We'd be happy to put a copy of my book in the mail. And of course, if you have any questions, clarity, if you want to learn more about Atlas, if you want to get your hands on that term chooser spreadsheet, because maybe you're trying to lock in your variable mortgage, you're not sure what term to choose, or maybe you have a renewal coming up and you just wanted to get some analysis and some opinion on that, we're happy to help. So yeah, what I'll do now is I'll open up for some questions. I know there's a couple of questions in the Q&A here, so I'll head over there now. Okay. So Irina asks, is a pre-sale a better idea? A pre-sale is a very interesting idea right now, actually. So one of the nice things about a pre-sale is you don't have to qualify today. And qualifying is harder because they take the interest rate and then add 2% on top of that for the stress test. And so it's harder for you to qualify for a mortgage today than I think it will be in the next couple of years. Also, you're not getting the mortgage today, so you get to get the mortgage when the rates are lower. And probably more importantly, in my opinion, is that the fact that you're not putting a tenant into the property today, you get to put a tenant into the property when it completes in the future. So the nice benefit of that, of course, is that right now there's a lot of upward pressure on rents, and that I don't think that that's going to change. I think it will slow down the upward pressure, but I don't think that the pressure is going to decrease and that rental rates will drop over the next couple of years. So the nice thing is you get to place a tenant at market rates in the future. And if you put a tenant into a property today, or even worse, get stuck with a tenant that it was already there for 10 years, it's really hard for you to catch up because you can only increase the rates the amount the government allows you to, which is usually an inflation adjusted number. Frankly, usually it's less than inflation. I think the last couple of years, they've only allowed 1 or 2% maximum. And that's very difficult for you to catch up to market rents, especially when in most urban centers in the Lower Mainland, the rental rates have gone up by between 15 to 22%, which is quite substantial. So I actually do like pre-sales. I don't always love pre-sales because you're making a buying decision today and then you have to close on it tomorrow. And some of these plans change, and I see this all the time where all of a sudden a client says, oh, no, well, now I totally forgot I have this pre-sale. Now I can't buy this other thing because I can't close on my pre-sale if I do this other thing. So there's a lot of little moving parts like that. But I actually like pre-sales right now more than normal. Adela asks, how does it work if I'm self-employed and my husband is salary? So what happened then is lenders typically will use, ideally if you're self-employed, they like to see your 2-year average for your income. So all lenders, what they look at is either minimum guaranteed income or what you've averaged for the last 2 years. If you're self-employed, you don't typically have a guaranteed income, unlike your husband who's salaried. And so for you, they typically want to see a 2-year history. Now, there are some programs where if you don't have a 2-year history, then there are some ways that you can qualify under different methods. We also have different lenders that if you're incorporated and you don't show enough income in your on your personal tax returns, but you have more money in your corp that remains in your corp, there are some programs that allow us to use more income for you. There's some other programs that allow us to state your income at a higher number in order to qualify. So there's tons of different options, and we're very, very adept at knowing how to get those types of deals done. So feel free to reach out if you wanted to get some help on that. Janet asks, for a mortgage renewal coming by June 2024, how early do you suggest starting the process? Good question, Janet. Atlas, the nice thing about it is it takes probably about 5 minutes to fill in, and then we can just assess your situation and give you feedback on what your options might be. So here's what some of our clients have done. And I'm not sure, again, if it will make sense to do this now or not, because we don't know where rates are going to go. But we had a number of clients a few months ago when rates look like they're going to, again, climb quite a bit. We said, look, we don't know where rates will be by the renewal. In a perfect world, the rates are going to go down by the time you come up for renewal. And that's what we're hoping for you, hoping for everybody, Janet, that rates will be lower by June 2024. However, if rates start to climb up, in some cases, it is a tricky situation, because then what you'll need to do is you're going to need to be looking at exactly how you're going to structure things. And in some cases, it may make sense to break the mortgage early. If the rates keep climbing and you can get a rate that's 1% lower than where rates have now climbed to, it makes sense to break the mortgage early, pay the penalty, and discharge it. So it is more work for you and more work for us, but we've done this for a large number of clients. If you want to do it, we can get your file started now. We can have it in the system. If rates go up, then we click the button, send it off, and then we just watch to see where rates head. And if rates keep climbing and climbing, then eventually it will make financial sense to pull the trigger on it. Adele, so the Atlas form, you can just choose employee. That's okay. There's no issues there. Yeah, for certain things, for simplicity, to not make things too complicated, that's one item that we decided to do, but we might change that. So you can just say employee in the form, and then it'll be okay. Dennis asks, can you talk about the upcoming mortgage rule changes and how it affects mortgage renewals? When will the rule come into effect? So Dennis, I'm assuming that you're talking about the new HELOC changes. And so effectively what happens is if you have a mortgage that has a line of credit connected to it and is readvanceable, that means that as you pay down your mortgage, your line of credit limit would automatically increase dollar for dollar. Now, the government loves to make things super, super complicated, and I can only imagine how much money this has cost the banks to change this, because this is probably literally costing the banks, I would say, tens or even hundreds of millions of dollars to change their systems around to adjust for this. But now what's going to happen is if your mortgage and line of credit combination is at 65% of the value of the property or less, then that means that every dollar you pay down on your mortgage, your line of credit will increase. However, if you have a total credit limit over 65% of the value of the property, then that means that that as you pay down the mortgage, the line of credit will not change. It will remain static until you've reached the point where you've paid down the mortgage and the line of credit below 65% of the value. And then every dollar that you pay down on the mortgage will increase the line of credit. So if you have a mortgage right now on a property that's worth $1 million and you owe $700,000 on it, and you have a line of credit connected to it that has a $50,000 limit. So you've borrowed $750,000 between the two. You still get to keep your $50,000 credit limit on your line of credit, but you will not see any increase to it until you've paid down the mortgage down to $600,000 and below. Because at $600,000 plus the $50,000 you owe with the line of credit, that's $650,000. That's 65% of the value of the property, which is about $1 million. And so it's only once you've paid down the mortgage from $600,000 down to $599,000. Well, now the line of credit limit will increase by $1,000 from $50,000 to $51,000. So that really what it's affecting is the readvanceable feature of having a mortgage connected to a line of credit, whereas you pay down the mortgage, the line of credit limit will increase dollar for dollar. So you can still do this on day one if you're borrowing 65% of the value or less. You could even have it so it's set up with this structure, even up to 80% financing, but it just means that as you pay in the mortgage, the line of credit limit will not increase until you start to pay it down below 65%, and then the line of credit limit will increase. So it's very complicated, and it's very it's a difficult rule to justify the bank or the banks having to adhere to. The government decided that they wanted to have that, and yeah, it's been rather challenging. I can only imagine how much it's costing the banks to do that. I'll go into the chat now and go through that because there's no more Q&A. Joanne, you want to learn more about Atlas? Absolutely. I'll make sure that that we get you some more information on that. Let's see here. Vivian is asking, for 5+ multifamily properties and buildings, are the interest rates higher than residential mortgages? So almost certainly yes. So usually for commercial lending, which 5+ units would fit into, typically the interest costs are more expensive. So normally you can expect a mortgage rate to be somewhere in the high 6s or low 7s, or even mid 7s for commercial lending. There are some exceptions, however. So we have 2 residential lenders that can do 5 or 6 unit properties using residential underwriting guidelines, residential rates, 30-year amortization instead of 25-year amortization, and all that. So that is a major benefit if you can pull that off, and we know which lenders can do that. So that's one option. The second option is if you can get CMHC insured multifamily financing, then the rates are actually much lower than they are if you're going with residential lending even. So only if you can get CMHC insured multifamily financing can you get lower rates. However, note that most commercial lenders do not do CMHC insured for less than $5 million loans. CMHC doesn't want to do them for less than $1 million loans. And the process is like a 6-month process to get the approval from CMHC. It's a really long, arduous process. And quite difficult to do. But in theory, if you can get CMHC financing, it can be much cheaper for you. Alex is asking, previous slide to the real estate sign with the fixed and variable comparisons, reducing the rate, what was the one to do or to blend and extend? So Alex, that slide that I was showing there, maybe I'll just try to grab it for you really quickly here. The slide was looking at whether you should be in a variable or be in a fixed rate, basically. Let me just go here. Just gonna go back. Okay, I'm just gonna share my screen really quickly. So this was just a comparison on what a current 3-year fixed rate is versus if you have a deep discount on your variable mortgage. And there's a very small handful of lenders that have discounts this good. It's almost every bank is prime minus about 0.2 or around prime for a variable rate mortgage right now, but there's a small handful of lenders. So if you're getting insured or what's called an insurable mortgage, so that's if the property value's under $1 million, 25-year amortization or less. If you're not refinancing, but you're either purchasing it or just renewing the existing mortgage, then you can get rates around prime minus 0.9. And then when you compare that these two interest rates together, so taking a 3-year fixed versus taking a variable, the variable seems to be outperforming the 3-year fixed over a 3-year period if you have a deep discounted variable. If you don't, then it doesn't make as much sense. So we can always do this analysis for you in your circumstance. And a lot of the time, what ends up happening is people want to know, should I lock in my variable into a fixed? Well, we can even get you to go talk to your bank, figure out what fixed rate they're willing to offer you. And then we can run the analysis with what your current variable rate discount is, compare that to what you're getting offered on the lock-in. And we can run the analysis to see which one is likely to cost you more or less in interest. All right, guys, I don't see any more questions in the Q&A. Any more questions? Anybody else want to ask any more questions? You guys are taking it easy on me tonight. It's probably because you're so happy that the Bank of Canada didn't increase in rates. I guarantee if the Bank of Canada increased rates today, it'd have a lot more people asking questions, probably a lot more people freaking out. So I'm very glad that the Bank of Canada decided not to increase rates. Awesome. All right. Thanks so much, everyone. It was really good to see a lot of familiar faces. Looking forward to talking to many of you in the near future here. And I'll see you guys next month. Thanks so much. Bye now.